Hey everybody, it's Eric. Welcome to this video presentation for 60 DTE SPX SPY conservative options trading for income and steady account growth with high probability put credit spreads. And 60 DTE, for those that are new or not sure, I use a lot of acronyms, so you can always ask me. That is the number of days to expiration. DTE is days to expiration. We're going to look at both SPX and SPY so that depending on your account size, we'll also look at some different trading frequency, but depending on your account size, you can choose to trade this exact same strategy with SPY if you kind of want to start out with a smaller account or just want to try it out. And then it's easily scalable to SPX, which is a larger product. But again, we're going to be using the exact same strategy. And I've titled this, conservative options trading. And that's kind of a tricky word because there's still a lot of risk, and we're going to talk about the risk as with any options trading strategy, understanding the risk, defining the risk. But I'm using the term conservative here because really we're going so far out in time. It's a super high win rate. And we're going to couple this with a hedging strategy that I'll do in another presentation we'll talk about later. But I really think that this is a great way for you to build your account and over time looking for decent returns, nothing crazy. You don't have to watch the market all day. So to me, it's a little bit more conservative, and it's closer to more of a swing trading, if you want to term it that way, where you don't have to trade every day or every week. You can simply put a trade on and let it play out, depending on how much you want to trade it. And we're going to look at different frequencies of this trade because we have weekly options. We can put a new trade on every week, and we'll kind of see how that plays out as well. So we're going to really explore a lot of parameters here. And I hope you enjoy this presentation. So let me do the disclaimer real quick. This presentation is for informational purposes only and should not be considered investment advice. I am not a financial advisor of any kind. I do not hold any certifications or registrations. Options can be risky and are not suitable for everyone, as you probably know. You can lose all of your money trading options if you do not understand how they work. Now, we're going to be trading put credit spreads, so we're defining our risk. We don't have any unlimited risk in this video, but you just need to understand options are risky in that manner if you're selling naked options, in which we are not. Past performance is not indicative of future results because we're looking at historical back-tested performance in this video. And the backtest results in this presentation show theoretical returns using end-of-day option pricing. So I wanted to get that out of the way. Now let's talk a little bit about just kind of a quick overview before we dive into the numbers here. This presentation, we're going to focus on selling put credit spreads for monthly income, and you can swap that out for monthly income or account growth, wherever you're at in your life. On SPX and SPY using longer dated weekly options. We already said we're going to do 60 days to expiration. This system should be coupled with the SPX SPY hedge trade method. That is going to be a different presentation that I'll present at some point, and these two videos will go together, and you'll see why you're going to want to trade this or want to keep the hedge trade in mind. And again, we'll talk about that in a different presentation once we get through this one. And the general idea is this. We want to generate consistent gains from time decay. And we're going to try to minimize the way we think about volatility and what we think the market's going to do. We want to get away from predicting what the market is going to do and what the IVR is. We all know that SPX and SPY, the implied volatility is always pretty low because it's an index. So we're not going to be using volatility or technical analysis really, or anything to kind of tell us what we think the market's going to do. Now, I've done a lot of that with my short-term trading, which I think is more valid. But with these longer dated options, we really want to try to take advantage of the time decay using high probability spreads. And there's different ways to trade this, but the way I'm looking to put it in is opening a new trade, one of these new 60 DTE trades, creating multiple open trades at a time. And this is where you get into how much of this can you handle, how big is your account, and we're going to look at different ways to minimize the frequency. You can trade this once. You could trade one trade at a time, meaning you trade one trade and you'd be in it for a month or two and then wait 2 months to open a new trade. Or you could open a new trade every week let's say every Wednesday or every time you get to a 60 DTE expiration, you can trade weekly options that are 60 days out. So it's really up to you how you want to take this information and trade it in your own account. And the frequency can be up to you. And maybe there's I know as I'm making this video, there's a lot of trade talk around China. So maybe you want to wait till the announcement comes out before you put on another one, that kind of thing. But basically, we're going to look at some different parameters. And the goal here is to make 25 to 40% per year on the money allocated. Now, that number is based on trading it every week. If you're going to trade every 2 months, it may work out to be the same because you're not trading that much at a time, but ultimately we're looking to make 25 to 40% a year trading this strategy with a fixed amount of money. That's the money allocated. Doesn't mean you should put your whole account on this strategy. That would be ridiculous. So it's really on the money that you allocate to this strategy. So if you allocate, let's say, $10,000 to this strategy, we would expect or look to be, our goal would be to make $2,500 to $4,000 on that $10,000 over the course of a year. Obviously, we're looking at a big 10-year, we're going to be looking at a long-term look back period, and each year is going to be different, but it should be relatively consistent, especially when we factor in that hedging strategy that we'll talk about later. So one more slide I'll go over. For this research, I'm using a newer software that I haven't presented before. I just kind of got it through another one of our members, Robin, here on Patreon, recommended it, and it's really cool. I'm going to put a link. If you're watching this on YouTube, I'll put it in the YouTube description. If you're watching this on Patreon, I'll put it in the post, and you guys can check out that software. It's really cool. There's a lot of good parameters there, and I'm kind of getting used to it. And I'm gonna walk you through some of these things too, so you might be interested in getting the software for yourself. You can backtest all kinds of things, but we're going to explore different trading parameters such as the frequency that may better fit your account size, and we're going to look at SPY and SPX. But the overall goal is the same. We're looking to use a fixed amount of capital to make consistent gains with an easy to follow, defined risk methodology. Now, for those that have been doing put credit spreads a long time, none of this is going to be that new to you. I think the results will be new, and some of the things you can do with the certain deltas and the time frames, I think that'll be new. But so this isn't going to be a full lesson in put credit spreads and how they work. It's more what we can expect to see, and you're going to see some things that you probably expect, but also some things that I don't think you would expect. So it's be pretty cool. So with that, let's go ahead and dive into the software. All right, so I'm logged into eDelta Pro online, and I've already got the SPY strategy up, and I want to talk through some of the settings just so you understand what you're seeing. I think it's going to make sense to you. First of all, in the upper right-hand corner, you're going to see the dates. I'm looking back 10 years. That's the most you can go back. So we do want to keep in mind that this is in context of a bull market. And you've seen in some of my other videos, the easiest way to keep this trade in the context of a bull market is to only trade when you're above the 200-day moving average. And we'll look at a different setting in here for that if you want. But basically, we just want to keep that in mind and know. And I've seen this with multiple strategies. Things that work on the upside, such as put credit spreads in this market, is not going to work on the call side. So when you approach the call side of the market, you have to trade differently. The cool thing about this strategy, which I'm actually kind of excited about, is that because you're only trading the put side and the market tends to be bullish, it's a lot easier. You don't have to deal with the call spreads. And then putting on that hedge trade is how you avoid that giant loss, or at least minimize the giant loss. And again, that's going to be another video, but I'm not going to be trading the call side here, even though we'll try to hedge with call side, but I just find myself always defending that, maybe because we're still in the bull market, but you guys know what I'm talking about. So anyway, so I'm logged in. So first thing we're going to do, we're going to short a put spread, and we're looking at the delta 14. Now we'll look at a couple different settings. I've ended up on delta 14, and we're looking at SPY, and it's delta 14 minus $4. So what that means is we would be selling a delta 14 put and buying 4 strikes lower. So this is a 4 strike with spread on SPY. What that requires is $400 in capital for one trade because it's the width of the spread, and then you get the credit, and the max loss is that difference. So for SPY, I mean, you can adjust these parameters and everything, but this is kind of where I ended up, and I think the return on capital is, I think you'll like that when we look at that in a second. So that's the trade. Our entry conditions are going to be, we're going to open the trade when there's 60 days to expiration. I'm going to just change this to sequential, the frequency. What that means is it's going to trade it only basically one trade at a time, and once you're out of the one trade, it'll then look to trade another one. So this is one trade at a time. This is the smallest smallest trade you can do for this strategy, which is taking $400 and trying to make some money off that over the course of 60 days. Okay. If you reach 95% of the max profit, you're going to close that trade. So that's somewhere in the neighborhood of a nickel or a dime or something like that. And then we're going to avoid, we're not going to close the trade early on these some other parameters, and we're not going to use a stop loss, and we're not going to establish a trade right away. We're going to wait till the next 60-day expiration. So that's the general parameters. Selling a delta 14 with a fixed width, in this case for SPY, we're going to do -4 for SPX. We'll look at the results, but SPX, we're going to do a two-strike spread, which is about $1,000 in capital. So I'm going to go ahead and run this. It's going to take a second. Okay, so it's done. So let's scroll down to the results page and let's see what we're looking at here. So first thing is the actual return on this over the 10-year was about $1,100. And when you think about using $400 and making $1,100 over the course of 10 years, it's not a lot of money, but remember, this is highly scalable. The return on capital ended up being 300%, which is about what the market did, right? So that's sort of the settings here. It had a 96% win rate. There were 56 trade, only 2 losses. But let's look at those losses. This is the P&L curve. This is where this is what people need to understand. And this is exactly what you would expect is you're going to have a 96% win rate. But every now and then, in this case, you have one here and one here where you took the max loss. These are the average win here was $30. So if you sell a spread, let's say for $30 and the max loss is 3 something, then every now and then you're going to hit that max loss, and that one loss is going to wipe out, 8, 10 trades. It could very easily do that. And this is with no management. And that's something we're trying to do is not have to really deal with any management. And this is what that looks like, right? You had a great run, and then where was this? This is probably January 2019. No, this was 2019, the Christmas plunge, right? This is when Munchin came out and called the banks or whatever. But anyway, this is the pain, right? This is the pain. This is the high probability. Some people, don't ever want to deal with that because it gives up all their games. But still, if you only traded this over the course of the last 10 years, you would have, almost tripled your account, or at least tripled the amount of money. I shouldn't say your account. You tripled the amount of capital you use for this trade. So this is where we're going to look at trading a hedge trade, to where when these things happen, that you actually make money on the hedge to minimize it. So it won't completely wipe it out, but maybe instead of having 8 months of losses that are erased, maybe you only lose 1 or 2 months of losses, or maybe even make money depending on how bad the plunge is. So that's something that we'll be adding, but I wanted to show you the kind of starting amount here, okay? So let's scroll back up. So this is one trade at a time, meaning you take a trade, and let me go to the trade log. I know you can't see all the buttons here, but you can see, and the dates are cut off a little bit, but can you see that? November, January. So basically every other month you're taking this trade, right? So for you to wipe out 8 trades, in this case, 8 trades is 2 months, that's 16 months, right? So you just have to be prepared for that. If you're going to trade one contract with no management, you're going to need to do the hedge trade. So next thing we're going to do is let's increase our frequency a little bit. And this time I'm going to just kind of skip to trading this. Well, first we'll do, we're going to trade it monthly. Okay, so this time we'll have 2 trades open at a time. We'll open one with 60 days to expiration, and then the next month we'll open another trade with 60 days to expiration. So you're going to need 2 sets of capital. So if you need $400 for the first trade, you're going to need $400 for the second trade, and they're going to overlap, right? So you'll have more than one trade open at a time. So in this case, you should only have 2 trades open at a time. So let's run that one. All right, so we're going to scroll down, and kind of as expected, you made a little bit more than twice the money, because remember before it was like 1,100, so we're doubled our money. Our return on capital is pretty similar. Our profitability is 96%. Instead of losing on 2 trades, we lost on 4 trades. So there's a lot of consistency here, and you can see in the same areas we had a couple dips, right? So so again, this is what you can do is you can choose your own frequency. Do you want to trade it once every 2 months? This is trading it every month. Let's look at the trade log and just kind of verify that. I know I'm not sure if that's cut off, but it's November, December, January. It may have, looks like it skipped February. Sometimes it'll skip a month if there's a volume or strike issue with the data. So it looks like it may have skipped February in that case, but you can see basically it's taken a trade just about every month for 10 years. So let me close that out of that. So let's go ahead and bump this up to, this time we're gonna trade it. I'm gonna put up to 8 max positions, and we're gonna trade this weekly. So every week it's gonna open a new trade, and you'll end up with several overlapping trades. That means for every trade, if you have 8 open positions at a time, and each position in this case requires $400 in capital, you're going to need $3,000, $4,000 in capital to be able to trade that. And again, that should not be your whole account. That is how much money should be, needs to be allocated for this amount of frequency for this trade. So let's run that, and let's see what that looks like. All right, so let's look at the results for trading this every week. And an interesting thing happens here is a couple things to me is you end up with a couple more dips because you're in the market more, and you're definitely gonna be in for all the dips. But the dips start to be a little bit shallower, and you can see first of all that the lighter color kind of teal line, that is your P&L as the trade, unrealized P&L as the trade is opening. So you'll see these spikes down. So for example, here in this section, you might be in 6 or 7 trades, and the market dropped 5% or something, and so all of your trades are going to be down. But ultimately, in this case, a lot of them recovered, and you can see that spike up. You did take some losses in here, but it changes the dynamic. So this is one of those things that you just need to consider. Do you want to trade one at a time and risk the one big loss, or do you want to trade multiple, increase your trade frequency, and incur smaller losses over time? And now, ultimately, the results, are pretty close. It's the return on capital is a little bit less, but you still made over 7,000. In this case, you would need, it's saying you had 2,500 in capital required. But you still ended up with the same win rate, about 96%. Your average win is still about the same. So it's really just scaling that up. And if you have a smaller account or just want to try this out kind of thing, I would definitely start with the SPY version. So again, the trade parameters are with 60 days to expiration. You can do this every week, every 2 weeks, every month, whichever options you want to do. Open a put spread, selling the delta 14. So you go down to the option chain that's 60 days out, and you find the delta 14 or the closest one to it. There might even be more than one, and you would look to sell that option and buy an option 4 strikes lower. And you can adjust the width if you want. I'm going with 4. I think that's a good width for SPY. You can do 3 too, but and then you put a limit order in to say, okay, I'm going to buy this spread back for a nickel, whatever 95% of that max profit is, and then you just let it go. Once you see the video on the hedge trade, you'll want to be looking out for that scenario that's going to help minimize some of these dips here. All right, so enough about SPX. Let's go ahead and bring up, SPY. Let's bring up SPX. This is the 60. Yep. Here's the SPX version. And it's very similar. 60 days to expiration, 95%. The only difference here, instead of we're going to do a minus $10, meaning we would sell the Delta 14 and then buy a $10 strike lower. So that would typically is 1 or 2 strikes lower, depending on if they have $5 strikes out at that expiration. So it's $10 width of the spread. So I'm going to drag this back to Delta 14. And again, I had 10 positions here, but basically trading weekly. You can trade it individually if you want, like the other one, but I'm just going to go straight to the trading, open this up every week. So let's go ahead and, again, same time frame. Let's go ahead and run that and see what it looks like. All right, so let's look at the SPX version. You can see it's very, very similar. Obviously, you made a lot more money, but it requires more money. The return on capital was actually a lot higher. So in this case, you needed $7,000, $8,000. Here's the interesting thing to me between SPX and SPY, and I don't have an explanation for this. With the SPY version, I think it was closer to 40, 50 days. SPX seems to it just seems like it performs better. I don't know why that is. It just performs a little bit better. Your average trade is going to be a little bit bigger. You still have some losses here, 95%. I think SPY was 96%. There's a lot of like minor variables in there, but it is a little bit different. But let's look at the P&L curve. You can see that you also had some dips here, but the dips are a little bit more shallow, I believe, with SPX, especially in this section. A lot of it recovered more easily, and this one needed about call it 8,000 in capital. You're in that trade about 45 days. So again, every week you're opening a new trade. You're expecting to be in it. Let's call it 45 days. So when that limit order to get out at 95% of the max profit, it's probably about a dime. Then you would look to close that. You can just leave the limit orders in place. So that's ultimately the strategy. That's the delta I'm looking for. Fun, let's change the deltas around a little bit. Now, one thing that to consider is part of the reason I'm doing the Delta 14 is because the hedge trade involves buying something even lower than that. So if you go lower, for example, and we'll look at this. Let's go and do this. I'm going to drop this down to selling a Delta 10 put credit spread, same width. It'll keep the width. And let's just look at that. So this time we're going to sell a Delta 10 put spread that's $10 wide on SPX, same parameter, 60 days expiration. We're going to open it once a week, and we're just going to let it ride until 95% of max profit. And let's see what that looks like over the last 10 years. You can see you actually made a little bit less money. The win rate's a little bit better, but if you want to call win rate or profitability consistency, it is more consistent, and the losses weren't that bad. So you have an option here. You can sell lower, and you could do this on SPY. I mean, I tend to trade SPX. You had a pretty good return on capital, but it's a little bit easier trade. It's just super steady growth. Again, context of the bull market. We still want to hedge in case of the big drop, and we'll look at that in the next presentation. But just something to consider. If you go even lower, let's do a Delta 8, and let's just see what that looks like. All right, so a Delta 8 gets you at 99% win rate, but again, you're lowering your returns almost by a third, because when we did the Delta 14, that strategy made was like 29,000. And now we're down to 21 and a half. So we'll call it, I don't know what that is, 25% lower or something like that. So, it's whatever you're comfortable with. That's the right answer. There is no wrong answer. But look at this consistency for just straight up monthly income. You still ended up with close to 300% return on capital. So if you started with, $7,000, $8,000, this is where you ended up. Okay, over the course of 10 years. It's a long time. But it's 10 years. And again, this is one contract at a time. We haven't even scaled up to 10 contracts at a time or anything like that. So someone who really has a larger account and you want to trade this with $70,000, for example, then you can multiply this by 10. You would have made a couple $100,000 over the last 10 years. So we're looking at that base value or base kind of contract, one spread at a time. It's still a little bit of capital. You know, it's not chump change here that we're starting to get into, but it's very scalable. You can start with SPY. Now, in my opinion, if you're going to do something like this, then I don't know. I don't know how that hedge trade is going to do, because you're going to end up wasting some of your profits to do the hedge. So I'd have to do that. So what I'm kind of going with is the Delta 14 version with the hedge trade. I would need to do some more research. If you're going to trade Delta 8, I don't know if hedging with Delta 2 or whatever is going to do anything for you. But that's sort of the idea is if we do Delta 14, we're going to increase our returns, our actual dollar amounts, and then we're able to hedge it. But this trade's a lot easier. You don't have to do the hedge. You could just say, okay, every Wednesday or whatever, I'm going to open up a new trade, and then I'm not even going to think about it, and just hope that the market stays in this stays above the 200-day moving average. So let me throw that in real quick. Let me go back to the Delta 14, and just for I'm going to add a filter where it's only going to take the trade if the 10-day moving average is above the 200-day moving average. So basically, the short-term price action needs to be above the 200, otherwise it won't take the trade. Now, in the last 10 years, we've had a few dips below the 200, and it was, as we saw in the results before, there wasn't really that much of a difference because the market recovered every time. Well, at some point, the market isn't going to recover, and that hedge trade is going to help save you, or you may just end up having a bad month and taking some max losses whenever that happens. So if you want to keep it in the context of the bull market, we can say, okay, only take this trade if the 10-day is above the 10-day simple is above the 200-day simple. And let's run that, and let me just kind of show you what that looks like. All right, so now we can see that, by only trading when the 10 was above the 200-day moving average, we reduced our gains, and we still had some risk in here. And you can see some flat lines where the market dipped and we flatlined and we wouldn't start trading it again. So the P&L curves looks a little bit different because we're out of the market. The downside to doing this is when the market does dip and you go to open that next trade, the volatility is higher. You're able to get farther away from the money. It sort of improves the probability, if you will. But again, this is all we can do. We have 10 years of data and we've been in a bull market. This is the best we can do. I cannot test this in 2008. I personally don't think there's going to be another drastic 2008 with the way the Fed is anymore. We'll definitely have a 20% correction at some point, but a 50% move, maybe, I don't know. That's just my opinion now that the Fed's pretty much jacking up the market forever. But anyway, I just wanted you to see, again, we're just exploring the different parameters and different options, some things to consider. There isn't a right answer here. It's whatever you're comfortable with. It's whatever you understand. It has to do with how much money you have and how much you want to put towards something like this. If you want to trade this at all, I think it's pretty, I plan on trading it. I'm already trading. I'm in some 60 DTE stuff already. And so with that, I'm going to wrap up the put credit spread version of the 60 DTE, and I'll get the hedge trade sort of companion with the Delta 14 spread here. I'm going to get that going, and I'll give that to you guys as soon as it's ready. I look forward to you guys' feedback, questions, comments, concerns, and I'll talk to you guys later. Thanks.